To me, one of the interesting things about life insurance is that you're not buying it for yourself, right? You're buying it for other people. So historically, this meant in order to sell life insurance, you really had to change people's minds about what was desirable, right? And what was moral and what was the right thing to do. So this idea that a good man, typically it was a man, should provide for his family even after his death, that was an unusual idea. And it took a lot of selling, marketing, to make that idea palatable to people and to make it something which was normalized.
Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I am pleased to be speaking with Alex Tabarrok, who is the Bartley J. Madden Chair in Economics at the Mercatus Center and a professor of economics at George Mason University. Along with Tyler Cowen, he is the co-author of the popular economics blog Marginal Revolution and co-founder of Marginal Revolution University. All right, and that's not just a throwaway line that he has in his bio that it's a popular economics blog. Their blog, marginalrevolution.com, is definitely in the top few economics blogs on planet Earth, right? If you polled a bunch of economists or econ fans and said, what are some of the top econ blogs? I mean, it would definitely be in anybody's short list. So what I have Alex on today to talk about is he and Tyler recently on their podcast had a discussion of insurance. And it was just fascinating stuff, a lot of historical allusions, and also just some economic analysis that was a bit unorthodox. And so I thought, okay, I got to get Alex on to talk about that. But also Alex has written a lot and podcasted a lot about blockchain. And so since we here at Infineo are all about insurance and blockchain, I thought I got to get this guy back on. Okay, so here's my discussion with Alex Tabarrok. Let me just mention, I think the day I interviewed him, he had a book review that was posted in the Wall Street Journal. And so we will link to that as well, but it wasn't really relevant to what we were talking about. He's reviewing a book on occupational licensing, but I'll go ahead and link that just to show this is an important guy. He took time out of his busy schedule to talk to me for the benefit of you folks. So here's my discussion with Alex Tabarrok. Alex, welcome to the InFi podcast.
Great to be here.
So I have been listening to your podcast, Marginal Revolution, with Tyler Cowen, and in the recent past, you guys did a whole thing on insurance, and I said, I got to get Alex on to talk about that. And then you also talk a lot about blockchain and your other ventures, so we'll get to that at the tail end of this episode. Well, let's jump into the insurance element. So for one thing, you had some interesting historical anecdotes. Do you remember the stuff about the villages in India and the connection to insurance?
Oh, sure. So there's a funny paper by Robert Townsend. It's funny, you will understand why it's funny. This paper is published in Econometrica, and it's actually trying to prove something about the general equilibrium model. But what it does is it looks at these small villages in India and trying to figure out how much the people in the village self-insure. And what Townsend finds is quite interesting. He finds that if you want to predict a household's consumption, the best predictor is not that household's production, but the village's production. So sometimes the villages have good years and people consume a lot. Sometimes they have bad years and people consume less. And so what happens is that overall, it looks like the villages are self-insuring themselves. The villagers are self-insuring themselves really quite well. So if your field happens to be flooded this year, your consumption doesn't fall that much because your fellow villagers make up the consumption. So it shows that this idea of insurance goes back a long way and is something which people really want and demand and can manage in these villages.
And I guess it might be appropriate just to take a step back and say economically, like what function does insurance serve? Because it's not that it allows for more production. Well, we can get into that actually. But there in a situation like that, it's like, oh, it's not that the insurance is preventing fields from getting flooded or whatnot, or somebody suddenly having a heart attack. It's just that there's a small chance of some catastrophe hitting members of the community. And so they would all like to be able to share that risk in some sense.
Yeah, that's right. So if you have diminishing marginal utility, then a loss is worse than a gain is more painful than a gain is pleasurable. So it makes sense then to reduce your losses in a bad time if you're willing to do that, even though your gains go down in a good time, right? So you and your neighbor may self-insure if your neighbor's production is low one year, you give up some of your gains, which are low, which have low value. And in another year, when you are particularly diminished, then your neighbor benefits you. And so you end up on a higher, utility curve.
In the way you're using that term self-insure, you mean not resorting to formal insurance contracts provided by a third party?
Yeah, exactly.
Okay. And so again, a modern analog of that might be, and you can comment if it goes through the state, so maybe you don't like it, but the idea of unemployment insurance, right? In a modern first world context that, oh yeah, if you get laid off or whatever, then you can draw on this thing while you're looking for a job. And the flip side of that is when you are employed, you're technically paying into that somehow. But the idea is you're really gonna, for the rare time when you are unemployed, you're gonna really appreciate that. And you're willing to have some skim off the top when you are employed. That's kind of the notion.
Yeah. Yeah. I mean, the point is that historically there were, you might think, and sometimes it is expressed this way, that the idea of social insurance is something created by FDR, okay? Mm-hmm. And that nobody ever thought about this, before FDR comes along. But actually, people had created forms of social insurance which long predated FDR. The Indian villages is one example, but there were a lot of, as you well know, a lot of mutual aid societies. So you would join basically these fraternities. And one of the things that the fraternities would do, these mutual aid societies, is that if you were unemployed through no fault of your own, then other people would help you out, and vice versa. So there were lots of fraternities, mutual aid organizations, families, even some forms of private insurance, which long predate kind of the Social Security or unemployment insurance, which we're more familiar with today.
Now, you just had a sort of throwaway line in there where you said through no fault of their own, and that ties up to the next question I was going to ask you. So I remember in your discussion with Tyler, when you brought up this case of India and this paper finding that, the best predictor of an individual household's consumption wasn't its own production, but the community's. And he sort of scoffed at that and said he didn't like that model, or a problem with that model is that he thought it indicated there must have been a very high marginal tax rate.
Right.
So can you explain what does he mean by that? And then the problems and why you were quick to add that, if you're unemployed through no fault of your own, that's when your neighbors might come in and help you.
Yeah, exactly. So Tyler spent some time living in a village in Mexico, and I think that's where his knowledge comes from. And I think he's probably right that quite a bit of what goes on in these villages is envy, and nobody quite likes it when somebody gets ahead. And so how do you exactly distinguish insurance from bad events for just the idea that everyone should be equal, right? That if somebody gets ahead, we're going to take some resources from them and give them to somebody who has less. So I do think that does go on in villages. And I think one of the reasons to get out of villages is that you don't want to go to the big city, right? Where you stand on your own 2 feet. And if you make it, you do great. And if you don't, not so much. And you're not held back. Now, the mutual aid societies, you're exactly right, is that you want to be wary of what the economists call moral hazard, right? So if you know that you're going to be paid if you become unemployed, maybe you work less hard. Maybe you slack off and you get fired, and then you just sponge off other people. So that's why in these mutual aid societies, it was important that everyone knew everyone else, right? And so they knew kind of who was the good guys and who was not. And maybe you didn't let the people who were the lazy, the spongers, into your mutual aid society.
I knew this family, they were from Colombia, and they had a term for one of their cousins he just was constantly going from house to house, living on people's couches while he was looking for work. And they had a funny, a Spanish term for him that literally translated as, I think, house sucker.
Yeah.
So the two ends of the coin there. That it sounds great in principle to say, that's nice that the community chips. Even in a somewhat primitive one where they don't have formal markets with large insurance companies that are well capitalized and blah blah blah, but still they have that basic notion that if disaster strikes any one family, then the community chips in. And that sounds great. But then if you push it, you worry about, as we economists like to do, that, there's like the two perils where it could be that, if just there are really enterprising members of the community, it might be perceived as, they just keep getting lucky. And you really ought to share with the rest of us because we're not as lucky as you are, when you're just penalizing success and hard work. And also then the flip side of people who, quote, are consistently unlucky. It's like, no, it's not really so much about luck.
Yeah, and I think it's interesting that these problems never go away, right? So we continue to have these problems with our social insurance schemes today. So people worry people on food stamps, and they say, we shouldn't allow people on food stamps to have Coca-Cola and, fizzy soft drinks and things of that nature, right? So there's always, whether it's in the village or whether it's in these social schemes, there is this trade-off between how much surveillance you want to make sure that there's not moral hazard going on, and how much freedom for people to do their own thing.
It's funny. I remember growing up, I was in New York State, so I don't know if it's a state-by-state thing, but there was a push to force, this sounds, as I'm telling you this story, Alex, it doesn't sound right, but I'm pretty sure that it wasn't a law that you had to wear a helmet if you were riding a motorcycle, and they wanted to make it a law. Right. And that was one of the main arguments for why we had to do that was, no, these people get in an accident, we're paying their hospital bills. And that's why, so whatever one thinks of that, but just showing these things are all interconnected. And once you agree, we as a community aren't going to stand by and let someone die in the ER because he doesn't have health insurance or something, well, then that opens the door to all sorts of paternalistic regulations.
Yeah, exactly. This is one of the things that bothers me about the expansion of the welfare state, is that it generates moral hazard, and then that moral hazard is used for surveillance and other things to control people. So as you said, if we have health insurance, social health insurance, or socialized health care in some way, then the next thing that happens is, you're overweight, and that's creating a cost on other people. That's an externality, right? And if there's an externality, there should be regulation. But this is an externality which has been created by the program itself. It's been created by the socialization of healthcare.
So I do want to get to some more of these historical examples, but since we're talking so much about like the design and the incentives and so on, maybe let's just jump ahead to, I want to just get into the heart of insurance itself. And if it's done privately through contract, can it alleviate some of these problems that we're talking about here? Like, for example, life insurance policies, they can charge premiums. And if you're a smoker, they charge a higher one. So that seems like it bakes right into it, that it's not the rest of the people that are customers of the insurance company are subsidizing you if you're a smoker, that's handled through the premiums.
Yeah, no, I mean, that's exactly right. With life insurance in the private market, there's often so-called medical underwriting. So they'll come and, check your cholesterol levels and, check your heart rate and all that kind of stuff like that. And I think that serves actually two useful purposes. One, exactly as you said, it means that we have less cross-subsidization. The healthy are not subsidizing the sick and so forth. Everybody gets an actuarial sound rate. The other benefit, of course, is that it reminds people that, hey, I should reduce my weight. If you have to pay, on the margin a little bit more for your health insurance, your life insurance, that's another reason to get to be healthier. Maha.
Right. Yeah, just like with auto insurance, that if you have a bunch of speeding tickets or you've been in accidents, your rates are higher. So among other reasons, it does give that feedback for you to improve your behavior.
And again, I have almost of two minds of these things because, so some of the auto insurance companies, they'll give you a lower rate if you install a device which monitors your speed, right? Mm-hmm. And I was like, I'm not sure I always like that, though. I would like it on my kids' cars.
Right. Well, you're leading into what I was going to do as a follow-up, that I was going to ask you. It seems at some point, if they get too much information about the individual applicant, like the insurance element almost falls away, that they can do genetic screening and they know, like in principle, if they knew exactly when everybody was going to die and from what cause, well, it wouldn't matter what cause. If they knew exactly when everyone was going to die just by scanning them or whatever, or they had machines that could take a snapshot of the state of the universe and look ahead 50 years, then I guess insurance wouldn't even be possible. Do you get what I'm saying?
Yeah, absolutely. Yeah, we usually think that knowledge is a good thing. More knowledge is better. But that's not always the case. The example you gave is a very good one. So if we had knowledge about genetics and how that would lead to various diseases, and if that knowledge came at a time before we could actually do anything about it, right? Then that knowledge would actually mean we couldn't have insurance. In fact, one of my earliest papers was on exactly this problem, which is becoming a bigger problem over time because we are getting much, much more capable of A, measuring your genome, and B, using that to predict future diseases. And so this is starting right now to threaten insurance markets. And how you deal with that is going to be a big issue moving forward.
So can you give people an idea? So like, is there a sweet spot, or is it that, like, for an example, suppose someone said, well, this came up with the Obamacare stuff. I realize I keep interrupting myself and I'm not even finishing sentences here, but I'm remembering now the context of the last time I was really into this was during the Obamacare stuff where they didn't want to, you were going to be penalized for pre-existing conditions. And they also wanted to do a community rating where it wasn't just that they were going to give you a policy regardless of your pre-existing conditions, but they couldn't charge you too much depending on the difference. Otherwise, they could just say, oh yeah, if you have cancer, we'll give you a policy, but it's going to be $1 million a month premium. So they could de facto do the same thing. And so to prevent that, they were saying, no, you lump everybody into a pool and you cannot charge them the same. But they were allowing for smoker status. In other words, they were allowed to, under Obamacare, charge you a higher premium. So just in general, that got me thinking, is that, like, I would think my gut instinct would be to say, yes, the ability of insurance companies to ask, are you a smoker or not? And then to be able to monitor it somewhat to tell if people are lying helps the insurance market. I wouldn't say that spells the downfall of private insurance and that then life insurance can't work if they're allowed to know if someone's a smoker or not. And even smokers can still get policies. But again, the more information they're allowed to obtain on the front end, I guess at the very least, only people without a lot of genetic issues would be able to get insurance. So anyway, do you have a sense of, like, is there a point at which it flips, or?
Yeah, I mean, a lot depends upon what is a choice and what you can control versus what is out of your control. So with smoking, of course, you can choose to smoke or not smoke. With your genes, you don't have any choice about that. So there's really not a lot of benefit to revealing all of this genetic knowledge as far as the insurance markets are concerned, because there's nothing we can do about it at present. We can't change someone's genes at the present time. So that just means we're going to just reduce the possibilities of insurance without any offsetting benefits. Now, my paper, when I wrote about this, I did actually suggest a solution, which I called genetic insurance. And that is, before you take the test, you buy insurance over a bad test result. So that if you turn out to have a set of genes which mean you're susceptible to getting cancer, you would then be paid a lump sum, which would be enough for you to be able to afford the new higher insurance premiums. And one thing that's interesting about this, which I think you'll appreciate, Bob, is that John Cochrane independently later generalized this to what he called time-consistent health insurance. And this is a form of health insurance which solves this problem that how do you get long-term health insurance contracts without being locked into the same company, right? And so what he suggested was you have a health insurance contract, but if you move to another company, if you want to move to another company, you are paid the actuarial amount that your new premiums will require you to be charged. So in the same way that genetic insurance sort of solves this problem of revealing all this genetic information, time-consistent insurance can allow you to move around health insurance companies and still be insured over the long run.
I don't mean to be obnoxious, but it seems, couldn't someone word that's just going to push it back one step? Because then when you say, well, how much do I have to pay to get that pre-genetics test insurance? They could say, well, if you let us know a bit about your parents, we'll give you a lower price on that.
Yes, so, correct. Correct. Yeah, absolutely.
Okay. And I guess just for the true econ geeks in the audience, Alex, am I right in thinking more information helps, like if we had a central planner? And so when we say, like, oh, private insurance wouldn't work, I mean, really what we're saying is that they would end up being able to segregate and then offer it just to the remaining pool of people who had green flags. And so the society could still, if we felt bad about that, could opt to go down that route, and then we could just voluntarily contribute to some side fund to subsidize the people who just lost the genetic lottery. In other words, it's not that we have fewer resources to go around.
Right.
We have more information that can only help us in the aggregate. It's just if we're worried about the impact on these particular people who now, am I thinking about that right?
Yeah, no, exactly. Oh, that's exactly right.
Okay. And so then the issue would be, if you just leave it to decentralized markets, people
Yes.
might not contribute that just for no reason. And so, okay. All right. Well, let's maybe, I know. I wanted to still, though, push, while we're just talking about big picture, the economics of this and the abstract. So Tyler, at a few times, lamented, he seemed like he didn't understand the economic rationale of insurance, period. Well, let's say life insurance in particular. And he was saying, in general, like, why don't you just save more? Do you remember how he was doing that? Do you want to maybe try to steel man what his point was and then give your response if you disagree with him?
Right. So I think I should say one thing just in defense of Tyler is that Tyler is always willing to take either side of an argument. Okay. Right. So that's part of what makes discussing things with Tyler interesting, is because he can come up with interesting arguments on either side. Yeah. So, I mean, clearly saving is, well, let me put it this way, which I think is interesting, is that to me, one of the interesting things about life insurance is that you're not buying it for yourself, right?
Mm-hmm.
You're buying it for other people. So historically, this meant it really, in order to sell life insurance, you really had to change people's minds about what was desirable, right? And what was moral and what was the right thing to do. So this idea that a good man, typically it was a man, should provide for his family even after his death, that was an unusual idea. And it took a lot of selling, marketing, to make that idea palatable to people and to make it something which was normalized.
All right. So two things. I want to pursue that as well, because that did tie into some of the historical things you guys mentioned. But as far as Tyler, I mean, I think part of his point was, and you're right, I know sometimes he's just like doing devil's advocate and he just wants to like, hey, let's make sure we're not overlooking something here. I think he was saying something like, in general, if something's going to happen down the road, a fate's going to befall me, and then my spouse is going to be there and still have a mortgage or whatever, that if I had, instead of the premiums I was paying into a life insurance contract, which in a certain sense has an internal rate of return of 3%, I could be just plowing that into diversified mutual funds that have a higher rate of return. And that in general, it's not that, so I thought he was making an argument like that it's not that if you don't have life insurance, that means you're condemning your heirs to poverty if something should happen to you. But on the flip side, I thought, yes, that's true. But if you get hit by a bus next Thursday,
exactly,
the rate of return on your life insurance is astronomical. So that, I think like that's kind of the primitive. So maybe he thinks a lot of people are overinsured, but just the idea of, does life insurance make sense, period? It seemed like he was almost being facetious.
Yeah, if you knew that you were going to live to 100, then life insurance is not necessary. It's to take care of the unexpected when you die young that you really want the life insurance.
Okay. And then, so to circle back to what you just alluded to a minute ago, this was not on my radar. There's some of the stuff you talked about I had heard about before, but you guys had more details. But this part where you were saying, like in revolutionary France and then even in the US, and it was based on like some certain fundamentalist views of the Bible, people thought that it was not a noble thing for a man to think, oh yes, I'm going to make sure I take care of my wife and kids if something should happen to me. Can you just explain? Because that sounds crazy to people.
Yeah. So in a lot of countries, life insurance was actually illegal. So in France, as you mentioned, it was illegal until like 1850, quite late. And part of it, there was this idea that by having life insurance, you were trying to play God, okay, and take over God's role. It's actually God's role to take care of the widows and the children. It's not your role. And that you were messing around, like people say today, trying to play God, you're messing around with something which is sacred. This death is a sacred sort of event. And to introduce money to this part of life, namely death, to connect money and death was to connect the sacred and the profane. So people found it distasteful And for a woman, see, a woman would say, it was often the women who didn't want the insurance because they would say, I don't want anyone to think that I'm going to be better off if my husband dies, right?
Mhm.
I don't want anyone to think that I want to get some money when my husband dies. Like, how could you possibly think that getting money might help me if my husband dies, right? So there was this idea that it was just repugnant to connect these things. And it took a long time for people, and a lot of Christian ministers were involved in this, to say, no, 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 to leave your wife and children in penury while you're in heaven, that's a terrible, that's a terrible thing, right? You ought to be providing, you ought to be thinking of them even beyond the grave, and that this is your coming back to help them out and to be foresighted. And this is, I think, part of the 19th century America, right? So 19th century America also sort of rejected this idea that there was nothing you could do. It's just fate, nothing you could do. And 19th century America, like Ayn Rand's America, is all about, no, we're going to build the steamships, we're going to build the railroads, we're going to dominate nature, and we're going to even take control over things like life and death as much as we can. So this idea of having life insurance was part of exerting control even over something as significant as death.
Okay, yeah, that makes a lot more sense now that you've fleshed that out, that there is something unseemly. I mean, we see it to this day, like with life settlements,
Yes.
where people come in and they buy, and then you've got a portfolio of stuff that, in a sense, if these people just die sooner rather than later, my rate of return's higher, and that seems icky to a lot of people. And by the same token, too, as an economist, I don't understand why more people don't bet against their team if they're like in the championship. Because I would think you're hedged. Either your team wins, and that's great, and if your team loses, you get a cash payment. But most people, there was like a Cheers episode one time where Sam and somebody else had some algorithm that their buddies showed them, and they bet against the Celtics, and it was like they kept it real quiet. They didn't want anyone else in the bar to know that they were betting against the home team. Anyway, I guess that's just because economists are weird.
Yeah, I mean, anything involving the body, we often get these repugnant feelings. So death, obviously, being one of them, life, birth, another one. But also, this goes to explain why we get so freaked out about compensating people for a kidney donation. It involves blood, it involves internal organs and life and death. And we don't want money sort of impinging on that. But these things do change over time. Back in Adam Smith's time, being an opera singer, especially if you did it for money, that was like being a whore, right? This is a good, sex for money was a terrible thing today as it was back then. But even back then, using your voice to get money, this was, again, you could be an opera singer, but only if it was pure, right? Only if it was not contaminated with this greed or with this desire for something as impure as money. Today, we wouldn't think about that at all, but these things they change.
Huh, that's interesting. You guys brought up another interesting element of this where you were saying there's a sense in which, let's say it's a man who takes out a life insurance policy, that the insurance company in some way implicitly is relying on his wife, if he's married, to monitor his behavior. And so do you remember what I'm talking about? That element of it? Can you unpack that?
Right. So, yeah, I mean, I think we were talking a little bit about tontines, right? And tontines are this interesting form where everybody contributes to a pot, right? And the person who dies last inherits the pot, okay? So this is a way of raising money as good as you're worried about living too long, right? And that seems very odd to us, tontines, but I pointed out that if you own property jointly, as I do with my house, with my wife, right? Then it's like a tontine, because if I die, she gets the house and vice versa, right? So each of us then becomes a residual claimant, right, on the other person. And hopefully that has some good aspects. Maybe it has some bad aspects. Maybe the wife really likes the house and doesn't want to take care of me, but maybe if I'm earning money, she doesn't want to take care of me. So yeah, there are lots of these things. And I think, as you said, the insurance company implicitly, of course, wants the insured to live as long as possible. And so they would certainly like the wife not to want the husband to bump off, but to remind him to go see his doctor.
Well, we're right. I think it was, besides the tontine discussion, but also there was another part too where you guys got into it where you might be at a disadvantage, because I just re-listened to the episode.
Yeah, okay, yes,
that's why
it
was where I'm sort of playing dumb. Like, do you remember that part? And I think it was something like you were saying, married men tend to live longer than unmarried men.
Right, yes.
Okay,
yes,
and the backdrop of this is, of course, given that a company issues a life insurance policy, they would prefer you to live longer.
Right,
because even if you paid the premiums up, the present value of that is a lower payment from their point of view. The longer you live, and the longer they get to wait before they got to pay the death benefit. And so, why is that? And to the extent that it's not purely just a sorting thing, but that actually, a man living with someone who's constantly like, hey, you sure you want to eat that? Or geez, or, all that. You can't be driving motorcycles anymore. That's too dangerous. That kind of thing. Or just in general, him having kids and whatever, realizing like, oh yeah, I got to be more responsible. There's a sense in which like the life insurance company has its agent there on the spot, giving you those incentives, besides just the broader stuff of, oh, gee, if you're a smoker, then they charge you more, so they're giving you incentives that way. But anyway, that was part of it that I thought was pretty funny. Okay. Another one you guys talked about that was fascinating was the Great Fire in London and the connection with the guy who started an insurance company.
Yeah. So 1666, the Great Fire in London burns everything down. And this guy, Nicholas Barbon, he is a developer. And so he's doing very well in building all these buildings. Quite controversial. It's quite interesting. So he wrote, one of the reasons he's remembered is he wrote In Defense of the Builder, which is a pamphlet. And it's a very YIMBY, we would call it today, YIMBY pamphlet. Yes, in my backyard. So he is defending the builder. People were worried about things like, when you build, we're not worried about this so much today, but at the time, they were worried that the cities were drawing too much population from the countryside. Mm-hmm. And they were depopulating the country. And Barbon said, no, look, people need houses, the population is growing, there's a natural equilibrium, and then the people in the cities, they're buying all this lumber and timber, so that actually increases demand for the products of the agricultural areas. So it's quite good economics. So he's a developer. And of course, with fire on people's minds, one of the things which he gives with his new developments is he says, look, we also will insure you. He creates the first joint stock company to provide insurance. And that's great because you have this joint stock company, which means that each of the people who, give up money, it subdivides the risk. That's the big benefit of insurance, is you're subdividing this risk among many people, making it easier to handle. So he creates this joint stock company, first joint stock company for fire insurance. And again, super clever, he creates a private fire brigade, okay? Which totally makes sense, because if you think that there's some moral hazard, then you want to make sure that people are investing enough in preventing the fire, and that's part of what the fire brigade does. And of course, being a fire insurer, he learns a lot. The company learns a lot about how to avoid fires. So this combination is really a pretty powerful combination of you sell fire insurance and fire brigade services. And that makes you want to do better on both, because you want to insure then places which aren't going to burn down, and you want to have a good fire brigade to improve your insurance. So these two things really go nicely when bundled together.
Well, I love that because, as you know, Alex, when I was in grad school, was writing some theoretical stuff on how a purely free society could possibly exist. And then that was analogous to what you just said was my solution, or saying this could work. It could be like this for military defense.
Right.
And I was saying, well, geez, if you didn't have, a political state, wouldn't some group of free individuals just voluntarily exchanging property titles, wouldn't they be sitting ducks for a foreign army to just come in? And I was like, well, if they had insurance, got a bunch of skyscrapers and there's insurance saying if this gets bombed or taken over by a foreign state, we'll compensate the owners. And then that company that's on the hook for that liability would then have the incentive to pay, for, surface to air missiles and for Air Force and, things like that. And obviously, I'll link to it, folks, if you're interested. We won't get to...
And that's exactly how people handled crime. Britain didn't have public police until like 1859, I think, quite late. And so how did they handle crime? Well, you would join a prosecution association, like a mutual aid society, and this would provide insurance, but would also provide the police and the inspectors to go after someone who had victimized you. So you'd put up a sign, in your front window saying, we're protected by such and such prosecution association. And that meant that, see, if you're just robbed, you might just say, oh, well, I was robbed $50, but it's going to cost me $100 to go after the criminal. It's not worth it, right? But when you join the prosecution association, it is worth it for them to go after the criminal. So this provides a much better incentive structure.
And the reason is because if they got half the people in a neighborhood who contribute to them, if they stop the criminal who's going house to house, it's not just any one-off. It's like they're sparing all their customers. And so that's why it makes sense for them to do it.
Exactly. Yeah, you're getting economies of scale. You're sparing all of your customers.
And you're internalizing the positive externalities of crime fighting.
Exactly.
Like to use economist lingo.
Yeah.
Okay.
Exactly. And there's still remnants of this system which sort of exists today on the margins. I think I mentioned this in the podcast, but worth mentioning again. You may be familiar with the Thomas Crown affair, which is remade with Pierce Brosnan and I think Renee.
I definitely saw the movie.
Yeah. So in that movie, right, he is a thief and she is an investigator for an insurance company. She's not working for, she's not a police. Usually it would be the police.
Right.
But she's actually, because it's such a high valuable product, she is a detective hired by the insurance company to capture the thief who is Pierce Brosnan.
But what they didn't count on was he was just so charming and handsome.
Well, yeah.
Can't insure against that. He won the genetic lottery. All right. Maybe now we can pivot to, well, actually, you mentioned tontines, and then you guys had a discussion about it just in general. Why aren't annuities more popular among people? Because it seems like life insurance and then tontines in particular, that they're competing with annuities. And also you brought up reverse mortgages too. So can you just speak to the similarity and differences between those things and what your intuition is as to why the public, it seems like everybody, you got to have life insurance. Whereas it's not like everyone said, you got to have tontines. Like that's not a thing.
Right. Yeah, I think you should tell me, why don't people like reverse mortgages, Bob? I think it's a little bit of a puzzle.
Well, why don't you spell out what it is, and then I'll give my...
So the reverse mortgage, right, is, suppose that you're a couple or a single person. You own your home, right? You've spent you paid off your mortgage, and you own your home. And your home might be worth a lot, like $1 million, but you don't have very much income. Okay, you're not working, you're retired, you're not working, you don't have very much income. Like, how do you then get that asset value? That asset value, if you just keep it, eventually will pass to your heirs, okay? But in the meantime, you don't have any income. So you got $1 million house, but you don't have any money coming in. So a reverse mortgage sort of solves this problem. It says that you promise on your death that the house will go to the insurance company. Okay, so they get the big payoff in the end. In the meantime, the insurance company promises to pay you an income and for however long you live. So it's like a reverse insurance in the sense that instead of you paying premiums and getting a big payout when the house burns down, it's you get the premiums and the payout is when you die and the insurance company gets the house.
And now, maybe another way of classifying it or thinking about it is, it's like you're buying an annuity, but instead of giving them a lump sum on the front end, you're giving them a promise saying, when I die, you get my house.
Exactly. Yeah, exactly. Yeah. And so this means that you stay in your house, you live in your house as long as you want it, and you continue to be paid this income. And if you live a long time, that's great. If you die, the house goes to the insurance companies, but you're dead. That's fine. You don't mind. So to me, reverse mortgages make a lot of sense, but they do have a very negative connotation. And I'm not totally sure why, but they're just not, they haven't taken off.
my guess is, I haven't investigated this, but yeah, my guess is, and you anticipated this in the discussion with Tyler, is part of it is, oh yeah, if mom and dad die next year, then that's crazy. Like in terms of how much they got paid, then we the kids lose the house that we otherwise would have gotten in our inheritance. That's terrible. So I think there's that. There could be like an emotional element of, if it's like the house where a bunch of kids grew up in, one of them wanted to get, even if they were just going to plan on selling it anyway, something seems unseemly about that. I could imagine that. And also just with the numbers, like people might just suppose that, oh no, if we, because I haven't thoroughly researched this, but it wouldn't surprise me if it were the kind of thing that if you had the person or the couple that's thinking of taking out the reverse mortgage, if their heirs didn't mind the hassle of taking it over and then doing research and selling the place once they go, that they would end up with more money than just having the insurance company be in charge of doing all that.
Yeah. So there are ways of doing it. So, the potential heirs could pay an income to their parents with the understanding that when the parents die, the house becomes theirs. In fact, my mother had a life insurance policy, which now she's elderly, was not really necessary, but we thought, the kids said, well, should she just give up? Should she stop paying the insurance policy? And actually what we ended up doing, and a little bit more, but I suppose, is now the three sons, we pay the premiums. Okay?
Right. Mm-hmm.
Obviously we're going to be the ones collecting, but that kind of made sense since she'd put in quite a few years.
Mm-hmm. Okay, yeah. So interesting stuff. And then with my research, the benefit of the tontine is, real loosely, there's lots of moving parts, but one issue is for a standard guaranteed annuity, for the lump sum money that you give the insurance company on the front end, and then they're promising fixed payments until you die, that for them to be on the hook for specific dollar amounts, they're very conservative, right? That in practice, you probably managing it, you get a higher rate of return because they have to err on the low side just to make sure, in case a bunch of people in the pool live longer than expected, that sort of thing, or the returns aren't as good as they projected. Whereas with the tontine, there's no guarantee about what you're going to get. It's just, a bunch of people all go in. Things could be rated, either they could all be of similar age and health, or, the numbers could be qualified based on your characteristics. They can handle either way. But yeah, the idea is they put all their stuff into it to buy assets. It's kicking off income, and then it gets distributed. And then as more and more people drop out, those pile of assets are now getting split among fewer and fewer people. And so, there's that element. But so the idea is, in expectation, you think you're going to earn more via a tontine, even given the same other people in your cohort. It's just it's not guaranteed. And so like you're making more in expectation, but it's not, so it's just that trade-off. So anyway, there's quirks like that as to why one's
many years ago when I was teaching at Ball State University, the president asked for some innovative ideas for the university. Mm-hmm. And I suggested a tontine for the students that it would work in the following way, is that when you graduated, the university would give you like $1,000. Okay. And you might, well, how can we possibly make the economics work? Well, it actually makes sense because you could, since many people end up not graduating, right? You could charge like $500 to incoming students, okay? And, put that money in the stock market or bonds or something like that. And then because many students end up not graduating, you have enough to give them quite significant $1,000, much more than they put in when they graduate. So this was not implemented, but the president did like the idea.
Oh, okay. I thought at first you meant that the alumni, like as they started dropping off.
No. This is incoming and outgoing students.
I got you. Okay.
Short, a 4-year or 6-year tontine.
Okay, very good. Okay, well, we just have a few minutes left here, but I did want to skip to a different topic, but different for the general public. But in terms of what we're doing here at infineo, where we're taking life insurance and putting on the blockchain, not totally distinct, is that when you guys were in a different episode talking about candidates for the Nobel Prize, you wanted to give it to Vitalik Buterin, if I'm pronouncing his name right,
Vitalik,
the inventor of Ethereum. And so you want to just make the case for why you think that, he's an underappreciated genius, I suppose?
Right. Yeah. So I think Satoshi and Vitalik would both deserve a Nobel Prize. Satoshi, I think, is dead, so we can't give it to him. That's controversial, but that's what I think. Vitalik created Ethereum. And you think about, he created this, asset which is worth hundreds of billions of dollars. So that's a big deal. It provides a lot of insight into monetary theory, both Bitcoin and Ethereum. And Vitalik has done a lot of what we call in economics mechanism design, which is kind of figuring out, usually we say incentives matter, right? And you kind of figure out what are the consequences of incentives. Mechanism design sort of works backwards and thinks about, well, if people are using their incentives, if we want this outcome, what kind of mechanism do we need so that it is in people's incentives to create that particular outcome? And Ethereum is an example of mechanism design. And in particular, he and the Ethereum Foundation did a remarkable job switching Ethereum from proof of work to proof of stake, which is kind of an amazing thing, saved trillions of dollars or billions of dollars in electricity costs, but was also I liken it to these videos of these guys in Saudi Arabia who tipped the car over and who changed the wheels of the car as the car is driving along. You can Google that. You'll see some YouTube videos of that. So they did this amazing job of changing it from proof of work to proof of stake while keeping it going. And there's been a bunch of other mechanisms about proof of stake itself, about the design of the fee payment mechanism, auctions, all of this stuff is involved in what Ethereum has done. And Vitalik has been at the center of this. A lot of economics, a lot of incentives, a lot of thinking in the real world. So yeah, as a real world economist, I think he's at the top.
Yeah, that's great. And we could obviously spend a whole episode just on this stuff, but I last year went and gave a talk somewhere and they wanted me to think big and just talk about the future in terms of private arbitration and stuff like that. And I got into that element. So I first warmed them up with this idea of the things we were talking about earlier, Alex, in this episode of decentralized policing and things like that and regulation and so forth and insurance. And then I coupled it with, if you could have smart contracts on the blockchain, so people somewhere that, they could come together and just agree that, all right, we're going to have this contractual arrangement, and then they could each put their money into escrow and it's tied up in the blockchain. And then the agent, especially with AI, that could have the ability to determine whether the parties fulfill the contract or not, and then disperse the payments and whatnot. So there was just a whole lot of stuff that could happen and get around a lot of these issues about, we need to have a coercive state to do X, Y, Z, because in the free market, how could these other things work? And there's just a whole lot that this new technology of blockchain and being able to have a public ledger and to be able to see and verify that things happen. And then again, with smart contracts coupled with AI, I had it like a private judge bot was the angle I took, and just saying different people, like Orthodox Jews, could agree on the code that was going to guide their interactions, and so people could on the front end specify what rules or regulations do we want governing our interactions, and then the thing could render opinions on that. And if the community realized, no, that thing is biased, well, then the company that provided those wouldn't get any more business. So
yeah, absolutely. Yeah, I mean, Mark Andreessen said, software is eating the world, and blockchains, cryptography, these are examples of software doing that, lowering transactions cost and so forth. So I think it does make perfect sense to bring all of these real world assets onto the blockchain, where you can then transact them at much lower costs, stocks, bonds, and I understand you're doing it with insurance contracts. So I think that's extremely promising.
Well, great. So we should wrap up here. Alex, where, if people want to read more of your stuff or your books or whatnot, where do they go?
Go to marginalrevolution.com. That's the blog with Tyler. Yes, marginalrevolution.com. My blog with Tyler. You'll pick up, there's also MRU, which is Marginal Revolution University. That is our online platform for teaching economics. We are like the Khan Academy of economics. You find hundreds of really high quality, freshly produced videos teaching economics. You'll get to see my face a lot more. Don't know if that's a benefit, but you will. And but Marginal Revolution, and then you'll find from there a whole bunch of other related things.
Okay, great. So folks, my guest has been Alex Tabarrok. Alex, thanks so much for your time.
Been a pleasure being here, Bob.
Thank you everyone for tuning in. We'll see you next time.